As the year winds down, it's the perfect time to make those end-of-year financial moves that can significantly impact your progress towards financial independence. And every decision, big or small, contributes towards your long-term goals. The end of the year isn't just about holidays, it's a crucial checkpoint for your financial house. So let's dive into the 19 end-of-year planning issues you should consider if you're working towards financial independence. Now, to make this easy, I'm going to break this down into 5 parts to help you save money, optimize your investments, and keep track of your financial goals. And stick around because I'm going to share how you can get this free comprehensive checklist based on this discussion to help you keep track of all these important items. So let's get started. Part 1. Maximizing your financial independence accounts. These issues are all about making the most of your tax advantage accounts and positioning your investments for maximum efficiency. So number 1, maximize retirement contributions. Are you on track to max out your 401k, IRA, or other employer plans? The maximum salary deferral to an employer plan in 2025 is $23,500 plus catch-up contributions if you're over 50. If your employer is matching your 401k contributions, please don't leave money or tax breaks on the table. Number 2, strategic Roth conversions. If you're expecting your income to be lower this year than in the future, then this could be the perfect time to perform a Roth IRA conversion to pay taxes now while you're in a potentially lower tax bracket, ensuring tax-free withdrawals later on. Number 3, required minimum distributions, also known as RMDs. If you are 73 or older or possibly have an inherited IRA, make sure you take your RMDs before December 31st to avoid hefty IRS penalties. Number 4, tax loss harvesting. You have unrealized investment losses in your taxable brokerage accounts? Consider realizing those losses to offset any capital gains you've taken this year, and you can even write off up to $3,000 against ordinary income. This is a key strategy during the accumulation phase towards financial independence. Number 5, capital gain distribution awareness. Be aware of end-of-year capital gain distributions from mutual funds in your taxable accounts. You might consider strategies to minimize the resulting tax liability. Number 6, HSA contributions. If you have a high deductible health plan, have you maxed out your health savings account, also known as an HSA? For 2025, the maximum contribution is $4,300 for an individual and $8,550 for a family, plus a $1,000 catch-up if you're 55 or older. The HSA is the ultimate triple tax advantage account. Number 7, 529 account contributions. If you're saving for a child's education, consider contributing up to the annual gift tax exclusion of $19,000 per year per beneficiary, or even a lump sum of up to $95,000 to a 529 account, treating it as if it were made over 5 years, give tax-free. Part 2, tax and income management. These issues help you fine-tune your overall taxable income for the year. Number 8, mind tax bracket thresholds. Are you on the threshold of a higher tax bracket? Strategies like deferring income if possible or accelerating deductions, such as prepaying the January dental bill, can keep you in the lower bracket. If your modified adjusted gross income, or MAGI, is over $200,000 or $250,000 if married filing jointly, you may be subject to the 3.8% net investment income tax, or NIIT. Managing your capital gains are crucial here. For those on Medicare, be aware of how your modified adjusted gross income impacts the income-related monthly adjustment amount, also known as IRMAA. Surcharges for Part B and D. Number 9, capital loss carryforwards. Do you have any capital losses for this year or carryforwards from prior years? If so, there may be opportunities to take offsetting gains or use a loss to reduce your ordinary income by up to $3,000. Number 10, review estimated payments. If you receive any significant windfalls this year, like a bonus, stock, options, or inheritance, check your tax withholdings to see if estimated payments are required to avoid penalties. Number 11, marital status change. Did your marital status change? Your tax filing status is determined by your status as of December 31st, so check how this impacts your tax liability. Part 3, gifting and charitable giving. Giving can be a great way to save on taxes, especially for those who have achieved financial independence. So number 12, annual exclusion gifting. Want to take some money out of your estate and give it to your kids or grandkids? Don't forget the annual gift tax exclusion. You can give up to $19,000 per person per year per donee, gift tax-free. Number 13, charitable strategies. If you are charitably inclined, consider gifting appreciated securities or making a qualified charitable distribution, also known as a QCD, from your IRA if you are taking RMDs. If you typically take the standard deduction, $15,750 for single and $31,500 for married filing jointly, consider bunching your contributions every few years, perhaps through a donor-advised fund, to itemize in certain years. Part 4. Cash flow and insurance checks. These are important for your immediate well-being and managing expenses. So number 14, use your FSA or HSA funds. Will you have a balance in your flexible spending account, also known as an FSA? Check if your employer offers a rollover option up to $660 or a grace period until March 15 to spend unused funds before they're forfeited. Number 15, meet your deductible. If you met your health insurance plan's annual deductible, consider incurring any additional medical expenses before the year end, as the deductible will reset on January 1st. Number 16, QBI deduction. If you own a business, review your qualified business income or QBI deduction eligibility and the impact of Roth versus traditional retirement plans. Part 5. Estate and future planning. Your planning is not complete without reviewing your documents and looking ahead. So number 17, estate plan review. If there have been any changes to your family, heirs, or assets this year, take time to review and update your estate plan to ensure it reflects your current wishes. Number 18, financial aid planning. If you have children planning to attend college, consider strategies like reducing your income in specific years to potentially increase their financial aid packages. And finally, number 19, new laws in 2026. Will any new laws go into effect next year that might affect your overall financial plan? There you have it, the 19 critical end-of-year planning issues to consider as you wrap up 2025 and sprint towards financial independence. Remember, you can download the free 2-page checklist that covers all these points and more from my site. The link is right below. If you found this helpful, I would appreciate it if you hit that like button and subscribe for more financial independence tips. Also, let me know in the comments, which of these 19 issues are you prioritizing this year? Lastly, speaking of new laws in 2026, check out this video where I discuss the new laws going into effect next year that may impact your overall financial plan. See you in the next one.